For Morningstar, I'm Jeremy Glazer. It's a busy data week, and I'm here with Bob Johnson, our Director of Economic Analysis, for a preview of Friday's jobs data and also a look at what we've seen so far. Bob, thanks for joining me.
Great to be here today.
Let's start with jobs. It's obviously on people's minds. We got some ADP numbers on Wednesday, 214,000 jobs added in the private sector. Was this better than you were expecting?
It was better than I was expecting and better than the consensus was expecting. The consensus was about 185,000 jobs. That they thought it'd be relatively flat with the prior month. So it was a little bit better than people thought. Not scarily better or worse, but certainly better.
So signs that the labor market is holding up despite some of these other concerns that we've talked about. Where are these jobs added? Did anything surprise you in that breakdown?
I think there was pretty good growth. I think by sector or by size, we were pretty good. There was small, medium, and large businesses all added about the same number of workers, which is good because I don't like it when the big corporations are getting scared and they aren't hiring, but the small businesses are. That's a problem when those numbers diverge too far. And there was a pretty good balance this time around. So I was very pleased about that. One thing that wasn't balanced is that almost all the jobs were added on the services side of the house. Manufacturing was actually a small detraction from the number, losing about 9,000 jobs, which is a little bit surprising given I think manufacturing is kind of stabilized in here. So I was a little surprised the manufacturing number came out the way it did. We'll have to see how it comes out on Friday. Again, it's not a big sector and that's not a big number, but I was still kind of surprised to see it.
One of the things that I know you'll be watching closely in Friday's report is what impact it will have on the Fed's meeting later in March. What do you expect from that government report, and what would have to happen to really force the Fed to potentially move as early as their March meeting to raise rates again?
I think the consensus is for about 198,000 jobs added. I think maybe we could do a little better than that, maybe a little closer to the 210 to 220,000 that was the average for all of last year. And I think that that is a possibility, but neither the consensus at 198 or mine at 210 to 220 is anything that will necessarily force the Fed's hand. I think that the number where the Fed says, okay, we're starting to see inflation heat up. We've talked about the services inflation so many times in these visits, and that is heating up. And now they're kind of watching the labor market. If something surprisingly good happens in the employment numbers on Friday, they'll certainly have to consider acting sooner than later. And what do I think might force their hand? I mentioned the consensus around 200,000. If the number is 250, they're certainly going to have to think about it. If the number is 3,000, it's kind of a done deal.
So what do you think is potentially holding back job growth then? If we do get a lower number there, is it a monetary policy issue, or is there something else happening in the labor market?
Yeah, it's kind of interesting because we've gone through a big shift, and we probably don't even talk about it enough of what's kind of happened in the labor market. It used to be the labor market and the number of jobs added every month was some reflection of how businesses were feeling and how many people they wanted to add. And there was always plenty of people to add if they wanted to. I think we've turned into an environment now where the jobs number can't be a lot higher than it is because there just aren't enough available workers. We see it in the job openings report all the time. The spread between hires and the number of openings out there is very large, and it's clearly a situation where what's holding the market back is not enough qualified workers in the right towns at the right wage. And that's what's holding back the job market now. It's not that businesses haven't got enough opportunities out there for people.
Let's take a look at some of the other data this week. Auto sales, this has been a big driver of the recovery. Do you expect that to continue?
I think it's going to be an important part. I don't expect any slump there, but certainly it's been a key market for this recovery. Early on in the recovery, and I mean 2010 through 2012, we had double-digit growth in autos, and certainly that was a big help to the GDP calculation. In the last 3 years, we've kind of bid in the 5 to 7% range for auto sales growth, and every year in January when we start the year, we say, well, next year is going to be the year it slows. It just has to. And it never has. We thought last year would grow 2 or 3%, and instead it grew more like 5.5%. So clearly an industry that's surprised usually. This year, the auto industry, everybody is saying, you know what, we're going to be lucky to grow from 17.5 million units to 17.7, 17.8 million units for the full year. Kind of something that looks more like 2% growth. And, I think that's probably still a done deal. But I do think that the numbers so far in the year look a little bit on the upside. We got the auto data for February this week, and what it showed is that we sold 17.5 million cars on a seasonally adjusted basis. And that's about the same as it was in January and higher than it was in December. So again, remember I said for the full year we're expecting 17.7, so we're kind of off to a good start with those numbers already. Certainly weather's been a little bit of a help, but I'll take it any way I can get it. And the numbers look particularly good when you look year over year. We were up about 8% compared to a year ago, February to February, when you strip out all that seasonal stuff. Last February was a little cold, so maybe it's a little aggressive, but still, we haven't gotten down to that 1 or 2% rate that I really think we'll probably settle back into at some point this year.
A report that I know you don't look at too often, but did have a nice increase, was the construction spending for January. What's driving that number? Yeah,
and that's an interesting report because it does drive a lot of different parts of the GDP calculation. And so it is important to look at, but it gets broken down into so many pieces that sometimes we neglect it. And this week we just got January data, so it's kind of a stale report. And it's frequently revised, which makes it even scarier. Even when the data is that old, you'd think it'd be more accurate. But in any case, the construction number month to month was up 1.5% in January, which is one of the largest increases we've seen in a long, long time. And certainly suggests that construction is going to be a nice contributor to GDP this quarter to offset weaknesses that we may see in other areas. The strength was really in the public sector market, and we've said for some time the public sector has been slow to come back. It's been holding back the economy in terms of employment and spending, however you want to cut it. And the number in January, probably because we flipped a calendar, the number looked really good. Maybe not even sustainable, but it was 4.5% sequential growth in the government sector. So that was a nice to see. The private sector also did quite well. Housing we all know about, and that did okay. But what even did better is the non-residential side of the house, and there we had some really nice growth, and around 11% year over year. So that was really nice to see, and that's kind of broad-based too. With the only sector that looked worrisome at all was probably the commercial sector, which really didn't show much growth at all. And that sector, of course, includes retail. And of course, you can guess the interest right now in kind of building brick and mortar stores. So that was certainly something that's held the number back, but we've still done well in spite of it. The office space, for example, has been one of the particularly strong categories, and it has shown 30% plus growth year over year in some months. And so that's certainly been a positive factor in the construction number. And certainly when you see those kind of numbers, the office numbers going up, that's got to be good for the employment numbers too. The Purchasing Managers Index globally were released this week. What does it tell us about the state of the economy, both in China, Europe, and in the U.S.? Yeah, the news there was not so good, unfortunately. I think the PMI data was pretty poor across the board. Again, China was probably the worst because they're at a level where there's more people saying things are getting worse than better. They're at 48 on the index, and 50 is kind of the equal number saying good and bad, and 51 would be more thinking better. And so clearly they're on the wrong end of things. Not only was it below 50, but it went from 48.4 to 48, indicating that maybe things are still just a little bit worse. So they may not have hit their bottom yet. On the other hand, it isn't falling apart either, at least as near as we can tell. This number's been bouncing around between 47 and 49 for probably the last 18 months. So it's not like there's any dash to the downside here in the number that should have anybody newly worried, but it's certainly a little troublesome that we're not getting better. On the other hand, Europe and the U.S. were both above 50, but both declined. The European situation is probably a little bit more worrisome than the U.S. In Europe, when we had some of the QE events last fall, we started to see some improvement there. We kind of had 3 or 4 months of very nice improvement, got into the kind of the low to mid 50s, And now we've kind of dipped back and had a couple of bad months again, and we're kind of back to the low 50s again. And again, that's a little disappointing, but a lot of it's concentrated in weakness in France and Germany, heretofore the stronger parts of the data. And of course, the German numbers, because they're one of the world's biggest exporters, and certainly what we're hearing about world trade is certainly not good, and certainly they're a major participant. And so Germany is almost down there with France and Greece right now in terms of PMI readings. So meanwhile, the Spains and the other parts of Europe continue to do quite well.
And then you said the U.S. Was less worrisome. Why is that?
Yeah, because it was still above 50 as the European number was. It did fall back, but there was some kind of offsetting data, the ISM data in the U.S. that makes me feel a little bit better about the U.S. number, that it's improving. I tend to like to look at the ISM number just a little bit more than the so-called Marquette number, which compiles all the numbers from around the world. The ISM data showed the U.S. below 50, which is bad, but it showed an improvement, and a relatively large, one of the larger improvements we've seen in some time. So that got us pretty close to 50, not all the way there, but certainly a nice 1.5% improvement in the index. So we were pleased to see that, and we tend to favor that index. It seems to have a longer track record. But I will tell you that neither of these, the Marquette or the ISM-based surveys, have told us much. They seem to have been more following than leading lately. Manufacturing actually kind of stopped going down, if you believe the industrial production numbers, way back in June, and it's been stable since then. I mean, kind of 6-7 months, so not a little accident. Meanwhile, the ISM and the Marquette numbers in terms of PMI have kept on going down, and but they reacted very slowly when we hit the slump at the beginning of 2015. So I'd maybe not take those numbers as seriously as I used to.
Well, Bob, thanks for your analysis and all this data this week. I know you're traveling later, but we will hear from your colleague, Roland Chernowski, after that jobs report on Friday.
Absolutely.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.